I have a very good news. I have a very good news for you, is that actually there will be no new things in the last part of the lecture. I mean, almost no new things. It's not exactly true, but from the point of view of hard mathematics, we are almost there. We know now everything about NPV, and we know everything about IRR. Let's drink for that. And now we may sort of summarize that. We know pros and cons. So we have a beautiful, beautiful project. You are in hospitality business. You are travel and tourism business. So something for you. Project hotel. And the owners, you the owners, the owner is evaluating to renovate Holiday Inn Guildford. Where is Guildford, by the way? Anybody knows? Yes, southwest of London in England, United Kingdom. And what happens to be in Guildford? Anybody knows? Anybody? Yes, University of Surrey, obviously. Now, our Project Hotel. The initial cost is estimated to be £60,000, right? Year zero. But an extra investment of 50,000 will have to be made in the second year. I mean, to be very clear, year two. This renovation project will bring each year, from year 1 to year 5, £30,000. Our required return on this project, rate of return, is 10%. So now we have our task. Let's calculate NPV and IRR of this project. And we should give the answer basis on NPV and basis on IRR. Should we accept this project? Yes, we might try to calculate this. Obviously on the next page there is a table, but I would like you for a moment to imagine how to fill it up, because if at the exam you have something like this, you have to remember something. So let's read it carefully when we have pluses and minuses. So initial cost is 60,000. So we put it with the what sign? And an extra investment of 50,000, what sign? Will have to be made in the year, which one? Year two. And we have the income, the revenue, every year from the year 1 to year 5 of 30,000. So now we could calculate the flow each year, yes, and then we could discount it by our factor of 10%. Brilliant. And then we could calculate IRR, which takes a bit more time, unfortunately, because we could do it at the rate of 10 and 15 and then find the answer. Okay, normally we would just do it step by step, but we are very fast this year because it's all pre-recorded. So we are very fast, and we have the table. Let's analyze the table. Yes, I thought that you will spot this, because what happens? We have this sort of initial year, year zero. So we made our investment at 60,000. So it's in brackets. When it's in brackets, very often in accountancy it means minus. So this year zero, the building 60,000. And then we have every year this sort of sales revenue at 30,000. Okay? And then this is the warning point. In the year 2, we have this 50,000 expense, additional expense in our hotel business. So what happens here? As a matter of fact, we have this net cash flow of total, like of minus 60, then plus 30, minus 20, because it's 30 minus 50, 30, 30, 30. Brilliant. We have this net cash flow, because it comes to our pocket, or comes out, but it's our pocket. Then we discount it by this discount factor, right? It's in this line DCF, discounted cash flow at 10% is shown. So present value of each cash flow actually is 60,000, and then 27,273, then minus 16,529, and so on, so on. You could see it, right? So then we add it up, normally, as we do NPV, and we have NPV at 12,401. Is it negative or positive? Okay, you know what it is. And then the same exercise is done for 15%, and we come to present values. Obviously, they will be smaller because the rate is higher. So the net present value in this case would be 2,757. So still, at 15%, it's still very good investment, right? So, and then we have this formula to calculate IRR, 10 plus and so on, so on. And we come to 16.43. So you have done all these calculations, and what we have the situation where all is counted. And could we give us the answers? Because I went back. Our question was to calculate with the method of NPV and calculate with the method of IRR, and should we accept this project? So where we are here, so our NPV at 10% is 12,401. Should we accept the project? So, firstly, we have this project hotel, and we have the NPV rule. At 10%, the NPV is at 12,401. So, we should accept the project. Now, IRR rule. The IRR calculated with the formula, what we remember about the formula? That you remember when we made this trial and error approach, trial and error, we had large brackets and brackets there, brackets there, brackets there. Yes, obviously, it's not perhaps the very exact one, but it gives us a nice comparison. So this formula shows 16.43. So basis on that, should we accept this project with IRR rule? Anybody knows? Anybody knows if we should accept? Because on the first glance, it's pretty okay. 16.43 versus our sort of required 10. Who knows? So, ask your neighbors, maybe, or ask me during the seminar, because the answer actually is somewhere on this table, and we should know straight if we should accept this result on IR rule or not. Brilliant. Now we do the very small recap on IRR. Firstly, what are we doing? This is the pitfall number one. Multiple rate of return pitfall number 2. No rate of return, pitfall number 3. And question of size in mutually exclusive projects. This would be pitfall 4, slightly different from the 3 at the beginning. Now, using this as this recap, I mean, we use the word pitfall or drawback or some kind of inefficiency of this system. So pitfall drawback number 1 is investing or financing, or what? Because with financing cash flows, the NPV of the project increases as the discount rate increases. Yeah, this is the idea, that if you are lending money to someone, I mean you are borrowing, then it goes a opposite answer. Because this is the contrary to the normal relationship between NPV and discount rates. Because normally, you know, when the discount rates are higher, NPV tends to be smaller, normally, of course. So we have on this table this investing and financing issue. And then warning about non-conventional or non-normal flows. This drawback as well is shown here on the very nice example with the graph, because we have here 2 projects. One is minus 100, and in the first year, only year of the project, 130. The B is other way around, and IRR for both projects happen to be 30%. It's easy to calculate, it's 30%. So NPV, however, is 16.07. However, in the project A, it's plus 1607. In project B, it's minus 1607, and we have brilliant graphs just to show it. And then we have this drawback, pitfall, drawback number 2, multiple internal rate of return. And this is the possibility that more than one discount rate will make the NPV of investment equal 0. And we have this example here. At the period 0 is minus 60, period 1 is plus 155, and period 2 is minus 100. Yes, so we make the calculations at the certain discount rate, and we find that at 0 is minus 5, pretty easy to calculate. At 10 is minus 1.74. At 20% is minus 0.28. At 30, suddenly it's finally positive. It's 0.06. So we have the initial thought, oh, we have found it because it's somewhere between 20 and 30. But then we calculated 40, and suddenly we are at minus 0.31. The beautiful graph on the right shows this in perspective, because the second internal rate of return inevitably happens between 30 and 40, so it's 33.3. But I have the question to you. I mean, from the very start we know something. We know something. We look at this, at these flows, and they are minus 60, plus 155, minus 100. And we know something is not going on. Yeah? You probably know. If you do not know, please ask me during the seminar.